Hello, my name is Riaz Dines and I'm from final year of mechatronics. So I'm here to do my assignment on managerial economics, which is selfie seminar. So I'm here to do a seminar on the topic break-even analysis. So I'll take you through what is break-even analysis and how important it is for any business, and how do we calculate break-even analysis, and what are some of the limitations in this analysis. So we'll see everything. So basically, this is the analysis method where you get to know when your business starts into a uh, profitable mode. So this denotes like at what point or how much business you have to do to take your business into a profitable manner or a profitable status. So that is what is the break-even analysis. So whatever business plan or whatever business it is, either it is a product-based or service-based industry, break-even analysis is very much important, and this helps us in accumulating a proper business plan or a marketing strategy or a complete business strategy. So we do also have a break-even point in this particular analysis, which is a point where your business not goes in a loss or a profitable manner. So it is no loss or no gain point, which we call it as a break-even point. So this is one of the important aspect in the break-even analysis. So we'll see what are the calculations or formulations in this break-even analysis, and what are some of the basic terms that is to be noted down in this particular analysis. So this is the representation of the break-even analysis, and here we have the break-even point. So this is the point where your business not goes in loss or either profit. So it is the medium point where you're in a neutral mode. So yeah, break-even point is something where you will be using your fixed cost and the contribution margin. So basically, fixed cost is something which like you will have to allocate every month or every specific period of time. So I'll explain you what are some of the costs that involves in a business. So contribution margin is something which is calculated by the selling cost and the variable cost. So this is the basic formulation where you calculate the break-even point for your business based on units. So yeah. So coming to a business, these two costs are something which you will have to consider during a break-even analysis. Not only break-even analysis, this plays a very important role in all the financials in your business. So coming to the variable cost, it is a cost which varies every period of time, or based on the batches of production that you run, or based on the total number of units you run in the production, or total number of services you do. So this is basically the raw material cost, which denotes a large number of percentage in your variable cost. So that varies every month or every period of time. So fixed cost is something that you'll have to like spend it out in a fixed manner every period of time. So all your rent, salary, insurance, your telecom, or and other expenses that you do in a fixed manner every time. So that we call it as a fixed cost. And some of the common terms that you'll have to be aware of while doing this break-even analysis are unit price, so which is the costing of your particular product or a service. The total cost is whatever number of sales you have like planned to, or you have the units calculated. So that into unit cost, unit price tells you the total cost of your services or your sales, and for the production. So the total variable cost is something which is calculated by multiplying the total variable cost per unit into number of units. And the total revenue is the total sale cost. So whatever sale you're doing in the market, along with margin and other things. So into number of units gives you the total revenue. Total revenue minus total variable cost gives you the profit or loss. So this is a representation which denotes you what is variable and what is fixed cost. So I'll take you through a example of break-even analysis for a particular use case or a case study from a different source. So for example, if you take the cost of the particular product is around $20. So since dollar is a universal entity, have denoted with dollars. So let's take $20 as the selling cost. So let me consider my assumption to be 5,000 units to be sold in a particular period of time. So my total revenue would be $1 lakh. So coming to the fixed and variable cost. So let me consider my fixed cost, all the wages, all the rent, telecom, and all the calculations to be $50,000. And let the variable cost per unit, the raw material costing, along with the technicalities, let me consider to be $10. So multiplying this with the 5,000 units that we have like assumed, so it goes around 5,000 into 10, which is 50,000. So fixed cost and variable cost is the same. So let us consider the margin to be $10 per unit. So here is a chart which tells you the net profit for every certain number of products that is sold. So when you see only at this particular point, when I sell 5,000 units of my product, I get to a point where my net profit is zero. It is neither a loss nor profit. So that is the break-even point. So this is how you used to like calculate it. So basically, it is fixed cost divided by contribution margin. So there is a term of margin of safety which denotes you what is the assumed or the planned uh, number of units that is to be sold in a particular time, and you have the break even to be a specific point of time. When the budgeted units is more than the break even, that goes to a profit, or when it is below, it is a negative. So the margin of safety is basically denoted in that manner. It is a point where you cross the break-even point and you do the excess sales. So some of the uses of break-even analysis is to determine the financial strategies inside the entity. So this gives you a basic idea of how much sales you should have to do, and what are the places where you can like increase your sales, and how many units you will have to produce, and how you could optimize the production and the profitability and all those. So all the margin levels. So you'll be able to analyze completely in the financial factor and plan out things to go in a profitable way. Some of the limitations that exist in break-even analysis is we take fixed cost as constant, and the average variable cost that you calculate down is also constant, and it might vary when in actual time. So the quantity of goods that is produced is equal to the quantity of goods that is sold. So if there are certain amount of goods that is not sold, so that doesn't like come into consideration in this particular break-even analysis, and these are some of the limitations. So whatever business it is, break-even analysis plays a very important role to uh, understand the journey of sales and the financial considerations inside a company. So whatever the business is, this plays a very good role, and this gives a clear idea of how to manage the sales and the financials. So yeah, thank you so much.